Please have a seat, gentlemen. So today, this afternoon, we have Paul Simpson, the CEO of CDP. Used to be the Carbon Disclosure Project. Not quite sure how you changed the name, but that's what it's about. It's carbon disclosure issues. We've got Christian Thimann here. He is the group head of regulatory and insurance Foresight for AXA Group, the big insurance giant right here in Paris. Finally, we have Pascal Blanqué, the deputy CEO of Amundi Asset Management, a well-known financial economist, and of course, Amundi, the largest asset manager in Europe. I guess, why don't I start with a question for you, Christian, although I invite both of you to jump in as well. And you are on the task force that Mark Carney set up, choosing Bloomberg, I guess, as the chairman, and you as one of the four vice chairmen, to look at what are the potential risks to the financial system associated with climate change. And you're coming out with a report on that in just another month, I guess. There's been a lot of pushback from the oil and gas industry, for example, and we had Mr. Pouyanné from Total in that chair. We were talking just a couple hours ago about it. He was very skeptical. He said, look, beyond sort of 10 years, the net present value of oil stocks isn't even, of oil reserves is not even really reflected in their equities. Is there a systemic risk associated with climate change?
I would say there are two things that we need to be mindful of, which the task force has two roots. One is indeed a concern that there could be stranded assets that suddenly could lose value. And if I want an example where politics, of course, are very important, is the German energy transition, where we have seen a very, very significant loss of value that has also impacted investor portfolios. And the other strand is, of course, the Paris Agreement that has put out very ambitious climate goals. So we know if we want to reach these goals, we have to decarbonize the economy. And this is not just about green finance, it's really to fundamentally change the way we produce, consume, and transport goods and services. So this is the whole industry is affected. And what the task force is trying to do is trying to help firms disclose climate-related risks and opportunities in the annual report. So today, if you're an investor and you want to know whether a company is positioned on this issue, you rarely find information in the annual report. You find it elsewhere in the CEO speeches and some brochures and so on. And our aim is to mainstream climate-related risks into the mainstream financial reporting. So if we are successful, you would find regularly of listed companies across the world a section in their annual report that describes how the company is positioning itself on the issue of climate-related risks.
Pascal.
Yeah. One of the biggest changes I've seen from my window, the investment community in the last 3 years, is basically the spreading of a risk approach to the so-called ESG space, and specifically carbon. And the story goes like that. Actually, there are poorly remunerated risks. They are idiosyncratic and asymmetrically distributed across corporates. The probability they materialize down the road is high enough to take action now. And for financial reasons. And the biggest change is that there is no, or at least less than in the past, no perceived trade-off anymore between philosophical commitment to the cause and financial aspects of the portfolio. And in the real life, it has translated on our side. The starting point was with AP4 in Sweden. Actually, we built a portfolio lowering the exposure to carbon emissions and exposure to fossil reserves. We turned it into an index, went to see MSCI, industrialized the solution, and then went to under the auspices of Ban Ki-moon. Actually, we've been a founding member of this portfolio decarbonization coalition. Actually, it's all about $35 trillion willing to be decarbonized or rediversified. Actually, so this is the biggest change. Going with another one, actually, the challenge of the fiduciary duty. The fiduciary duty in the investment community at present time is phrased like that: maximizing returns, full stop. So this is a challenge to turn the phrasing of this fiduciary duty, at least saying maximizing returns in the long run. And the final evolution I've seen is basically the idea that long term is about path and process. And this is particularly relevant for this transition phase regarding climate change topics.
Coming back again, actually, Christian, the insurance industry tends to have some of the longest or the longest investment horizons of any industry. Banking arguably has one of the shorter horizons. That said, do you think that banks should be revealing the carbon intensity of their loan portfolios? We've seen a couple of banks, particularly in Germany, get ambushed by concerns about some of their coal lending portfolios. What industries do you think should or should not disclose beyond the sort of obvious suspects like oil and gas producers, chemical companies, and so forth?
I mean, I believe that everybody should disclose. It's very difficult to draw the line. If we've learned one lesson over the last 12, 18 months is that there is no clear line. So maybe you can think of the industry in concentric circles. We have coal in the middle, oil and gas around, energy, utilities, heavy industry, chemicals, light industry. But our plea is that everybody should think about that, because the climate-related risks can come directly through emissions, stranded assets, but they can also come indirectly through physical risk. For example, you have factories exposed to climate risks. You have factories on the shore. You have exposure to water shortages. So all sorts of risks. That's why our take is that everybody should do it. In the financial sector, yes, insurance companies and pension funds, they are the long-term investors. They should do it. Asset managers should do it as well, and you are fully engaged in the process. And for banks, they may not look at it very much on the very short-term portfolio, but they also have long-term exposures. So they will also be very well advised to look at very closely their portfolios.
Okay.
I would fundamentally agree with that, and I think to date we haven't got there. So the Intergovernmental Panel on Climate Change describes the investment industry as an aggregator of risk. Of course, that's what it is. It's the asset owners, the pension funds who sit at the top of that, and there's very little disclosure from them at the moment. The banks where they've done disclosure to date have tended to do it, this is in our own operations. And the shift that needs to happen is the risk in their portfolio, as you identify. And of course, France was the first country, as Minister Real referred to this morning, to legislate that investors must disclose on their climate risk. And as I understand it, the task force is going to recommend that closing the loop in financial markets. And that disclosure builds resilience. And I think that's why Mark Carney said climate change can be a risk to financial stability. Of course, unmitigated climate change will be a huge risk to financial stability and social stability, but an abrupt transition could also cause that. And Mercer, the investment consultant, put out a report before the Paris Agreement, which said 3 scenarios. Governments do nothing. Risk builds up in the system very slowly but gets very big in the long term. Governments implement a managed transition, which you might, I think, describe what the aims of the Paris Agreement is. Then risk can be well managed. Or governments don't act for a while and then suddenly they're caused to act, perhaps because the public finally decide they're going to change an election because governments are not doing that. And that would be the abrupt risk. So that's why we need that disclosure. The data and the transparency is what helps investors manage risk and builds resilience into the system.
If I may, Carney, in my view, made the point about the risk of abrupt changes in prices in the financial space during the transition phase, and this is where financial instability matters. It's the sort of apparent paradox, actually, because we are all embarked in a price discovery process, basically. And regarding disclosure, we are, as you know, fully supportive of the carbon disclosure and carbon footprint. But the point is that carbon footprint is a proxy, but it is not the end of the game, actually. We do think that we need to see more stress testing of the portfolios, multi-scenarios types of approaches. We need more granularity per asset class across the analysis. For example, the impact on the equity side is seen through dividends. The impact on the debt side is basically about default risk. And the last one is actually the dynamics. We need a better understanding of the dynamics of the supply and demand equation, specifically in the carbon space, but not only. Because they are impacted by social changes, policies, technology, etc. So it's not a static equation. That is part of the process or the path.
I mean, the carbon footprint, if you like, gives you a picture of today. But as an investor, the picture of today is not helpful to orient forward-looking decisions. Ideally, you want to see a film. You want to see a film going forward. How does the company you're about to invest in behave under different scenarios? Is it part of the transition scenario? Is it a risk, and so on? And this is why the task force is very much thinking around forward-looking information. So encouraging companies to say, how do they govern climate risks? How do they see their strategy over the short and medium term related to climate risk? How do they manage that risk in financial, operational terms? And fourth, have they given themselves any metrics and objectives target looking forward? That's really the challenge, to provide forward-looking information to investors.
And if we look now, and I completely agree with Christian, but the Paris Agreement sets the target the world has to go on to maintain safety and security in the world, a 2 degree or well below 2 degree pathway. So that's how we have to assess every company. Does it have a Paris compliant business plan? Does it have a 2 degree, a science-based target? And do the investors have, and this is why portfolio decarbonisation is important, have a portfolio strategy that's also going to do that? Because right now, as we analyse the world's largest companies' targets, most companies only have targets out to 2020. Perhaps that's understandable. Only 14% of companies have any targets out to 2030. And if you analyse those targets, they'll only get us 1/4 of the way of where we need to go to the 2 degrees. So that gap, the 75% gap in corporate ambition versus the Paris Agreement, is the risk profile. And the question then is, who's going to take that risk? Is it the business and investors, or is it society? And that will depend both on advancing regulation and how the businesses and investors manage that.
Well, maybe if I can jump in here and inject a skeptical note on how well these systems can be constructed. And I always think of the clean development mechanism. We just had the Kigali Agreement last month in Rwanda calling for countries to phase out the production of certain kind of air conditioning refrigerants that were supposed to replace CFCs. The clean development mechanism fostered a lot of extra production of that wasn't really necessary, and it had all kinds of byproducts. I'll never forget, I snuck at night into a chemicals processing operation in central China, where they deliberately expanded production with financing from a Mayfair hedge fund in London. They ramped up production of these exact air conditioning refrigerants. Why? In order to claim CDM credits worth they were getting €500 worth of credits for every incremental dollar they spent in investment to burn the waste gases from this process. And on top of that, I learned actually while I was there that it turned out the factory I'd snuck into also was part of China's nuclear weapons program. It was involved in also separation of uranium for the nuclear weapons program using fluoride processes. So you had the CDM indirectly subsidizing nuclear weapons production. Does that show that even with the best intentions, even with the best designed programs, or what people think are the best designed programs, that you can still end up with unintended consequences and gamesmanship that makes it harder to reap the gains of carbon savings?
I think absolutely. And if we look at the clean development mechanism, in a way it was, I think, a very valuable experiment, but had a number of flaws. But let's remember that humans are not perfect, our systems are not perfect, and we're now trying to solve an enormous problem. And what the clean development mechanism did is had a whole range of methodologies, some of which over time it revealed had no net benefit to climate change and were gradually phased out. And that's why in the end it went into a slow death when the European Union said we're not accepting these credits anymore because we've learnt. But I think there is a value from the experiment. So there was an unintended consequences negative. I think the other unintended consequence is that China is bringing in a nationwide carbon trading scheme by the end of 2017. And a lot of the learning that China got from the CDM enabled China to bring in the carbon trading nationally much faster. And that's accepted by EU politicians, quietly stated by the Chinese. So there's a negative consequence, the learning, but also the real advancement. And that carbon pricing in China means that every multinational corporation that buys something from China is going to have a price on carbon somewhere in their supply chain. Yes, it will start low in 2017, but can we predict Chinese policies? Can you do that? How are you planning for that in your supply chain? And I think that will focus the minds.
Okay, I'm about to turn to you, Pascal, but I want all of you to start thinking about your questions. We are going to have a couple of minutes for questions at the end here for our guests. Pascal, you were about to jump in on...
I'm less skeptical than you are, actually, because we are in a discovery process and building a learning curve, basically. And one of the goals is to shape and build what I call the ecosystem, bringing as many people as we can find to the table and the equation. Actually, and including the financial markets participants, because to an extent we are shaping a self-fulfilling prophecy. At the end of the day, we've got to have as many people as possible, basically aligned on the story.
Okay, with that, let's take a question, if we can, from the floor. I know it's late afternoon, but I'll give you a quick chance, and if I don't get one, I'll go straight actually back to Christian. Oh,
yeah,
you have another point?
just to make a comment, I think we are at a point where we've got two great opportunities in the investment community. One is the fact that ESG factors, including carbon, water is clearly the next one, are embedded now in the corpus of risk factors as investors define them. They used to build portfolio using momentum, size, growth factors, inflation factors. Now it's becoming mainstream to look at carbon as a risk factor and to build portfolio. This can provide a huge leverage effect from a portfolio construction standpoint. And the second thing is that we've got end investors and asset owners craving for yield at this present time. And there is a strong demand for building financing solutions, basically bridging the gap between this demand and assets, specifically in the infrastructure space, and even more specifically in the renewable energy space. And in the real life, we've taken an initiative, it's unique. We've created a joint asset management company with EDF, the electrical company. Staff 50-50. They are originating assets in the renewable energy space, and we are basically packaging funds and bringing end investors we know very well, actually. So this is a financing solution trying to channel this amazing excess of savings, searching for yield into that space.
Before we wrap up, I wanted to ask you, Christian, about African risk capacity, which is, we have tomorrow, I'll be interviewing on stage Mohamed Bouvequa, who is an Assistant Secretary General of the United Nations and the Director General of African Risk Capacity. And it's a fascinating experiment in using insurance to try to at least help people survive the consequences of climate change. What does AXA see in that project? Because I understand you've just become involved with it.
Yes, indeed. It's a great project. You know that, climate risks, when they hit you, is bad. If you have insurance, it's less bad. The problem is in Europe, about 50% of all damages are insured. In the emerging world, it's 10%. In Africa, it's 1%. So that's where the real problem is. So everybody has been thinking, how can we improve the insurability of climate risks in Africa? And now there's a great initiative. The African Union member states have come together and have created an insurance mechanism among themselves. And that, because if a state is affected, they may be in financial difficulties. But if it's a multitude of states, that is not the issue. So they have the funds to pay out, and they have established a system that is much faster and much more efficient in paying out. And so this is something established by the states, and insurance companies are backing it up. So AXA is one of the insurance companies backing it up as a reinsurance, because we believe we have an interest also in stabilizing and developing the African continent, and that's a great opportunity to sort of lessen the pains, I would say, from climate-related risks.
Okay. Thank you all very much. Let's give our guests a hand. And with that, my colleague Katrin Benhold will talk to us about adapting to green growth. Thank you.